Here to help you explore hot tax topics with industry experts is Buddy Dearman, partner with Dixon Hughes Goodman, LLP, Jay Goldman, principal with Boyer and Ritter, Joe Magyar, partner with Crowe Horwath, LLC, and Paul Mitri, vice president, regulatory affairs at NADA. Please give them all a warm welcome.
Okay, let's get started. Good afternoon. Welcome to New Orleans for our 100th anniversary celebration. I'm Paul Mitri with NADA's Regulatory Affairs Office. It's a pleasure to be with you. Let me just real quickly tee up what we're going to do. For those of you that have been around for a few years and have come to the convention, you'll know that we do this every year. It is an annual program, and it is a year in review on income tax issues that affect dealers. And the way we typically structure the program is I get with the three panelists. They are senior CPAs of their respective firms. I'll introduce them here in a moment. But what we do is we basically do a rundown of what issues should dealers be thinking about, either because there's been a new IRS proposal or perhaps some enforcement activity, or there are just some issues on tax returns that they think dealers need to be more focused on. We come up with the issues, and then we just do time allocations. We get PowerPoints put together and the like. So for me, the effort is really on the front end, and getting this coordinated with the panelists, and then we just hit the start button, and then they run through the material, and they do a very good job with it. Now, in terms of the panelists who we have with us, let me just go ahead and introduce them. Those of you that have been here before will know that we've had them with us before. First is Joe Magyar. Joe's right next to me. Joe is with Crowe Horwath, part of Auto Team America. Crowe Horwath does an enormous amount of work for us. Joe in particular, very, very valuable. They really contribute quite a bit to the industry, and we're delighted to have them with us again. And then next to Joe is Buddy Dearman with Dixon Hughes Goodman. Dixon Hughes Goodman, another great supporter to the industry and NADA. We appreciate all their support. And Jay Goldman also has been with us before, has supported us in a number of ways, and is a great contributor, along with Dan Thompson from his firm and many others, also with the Auto CPA group. So we're very fortunate to have all their support. Real quickly, I want to tell you one other thing. At NADA, our role is really twofold in the regulatory office. First and foremost is actually to advocate on your behalf. And so we tie in extensively with the CPA firms to try to figure out what issues do we need to talk to the federal government about, either produce a statutory change, try to create some type of safe harbor. That is always an ongoing process. And in fact, we've had many, many discussions to that effect as a result of the recent election and the fact that there's a new administration and there's new opportunities to try to seek some priorities that dealers have had for a while. So we're looking at that very closely. Now, with regard to the material today, we are going to get into what we do on the educational front. That's the other part of our mission. So we advocate and we try to educate. This is all about education and what's going on. We're going to cover the items you see here, but there's a little bit of a challenge. It's a year in review, but we have to turn the material in October. Now, of course, October was before the election. The election has changed the landscape a bit, and so it's had a big effect on the first bullet point you see here. The proposed rule on valuation discounts, Joe's going to tell you a little bit about that, but he's not going to talk to you a lot about it because that proposed rule, which was going to fundamentally alter how transfers within closely held corporations are valued, and really to the detriment of dealers, and it was really a huge threat, one where we submitted written comments and oral comments, and there was a broad coalition of business entities that had really tried to oppose it. We really believe this proposed rule is not likely to go forward now. That's obviously a very good development, not so much for this presentation because we have 18 slides devoted to it, and we only need a couple of minutes on it, but for dealers, we're very pleased about that. Now, by the way, that's not a foregone conclusion. Let me just tell you how this plays out. The administration proposed the rule, the IRS did back in August. They did not finalize it. One of the first actions that the president took, and this is very typical of new presidents, he issued a freeze memo. If a regulation has not been finalized, it locks it in place until it can be reviewed, and the new administration can decide if they want to go forward with it. So that proposed rule has not been finalized, which means it's not taken effect. It has been locked in place, and we believe we can make a compelling argument, along with many others, that the IRS should not go forward with this proposal and hopefully not make a drastic change in this area. So again, very good from an advocacy standpoint, but it does throw a little wrench into what we're presenting today. So Joe's going to manage to very quickly go through the first 18 slides, but spend the balance of his time, most of his time, on tax reform. And then Buddy and Jay will pick up with the remaining topics, and if there's time at the end, I'll come back up to facilitate a quick Q&A. So with that, I'm going to toss it over to Joe, and he can start talking to you about that topic.
Thank you, Paul. It's a pleasure and an honor to be presenting this workshop again this year as the NADA celebrates its 100th anniversary. As Paul noted, we're going to take a quick overview of the proposed rules on valuation discounts and skip through a lot of the slides that we might have otherwise spent some time this afternoon on. And so last August, as Paul noted, the IRS proposed regulations that would have very significantly impacted valuations of most dealerships and related entities. However, the new administration has frozen that process, and it's uncertain whether these rules will ever be finalized or move forward in any way. In addition, there's a pretty good likelihood that the estate tax and gift tax that this relates to could completely go away anyways. However, the IRS did propose the rules, and they would have changed the assumptions for valuing transfers to members of a transfer's family of ownerships in a family-controlled entity. And so why is that important? Well, historically, the valuation of a dealership or related entity would take into account what are referred to as valuation discounts. Typically, these are for lack of marketability and or lack of control, and they often range from 25 to 45%. So you can see here an example where if you're making a gift of an entity that has $10 million of value and you're transferring 40% of it, that works out to $4 million of the $10 million. Now, when you look at valuation discounts, because in the public or in the marketplace, if you wanted to transfer those interests, someone's not going to pay you $4 million for 40%. They're going to pay you something less than that. So we look at a 30% discount in this example, which is $1.2 million, leaving you a net fair market value of $2.8 million. Now, this could apply in the case of if the transferor is gifting it and hasn't used their lifetime exclusion, you'd be using that amount of your lifetime exclusion. It would have been 2.8. Under the new rules, you would have used $4 million of that. If you'd already used that up and you're paying gift tax, you would be paying gift tax at a rate of $1.6 million under the new rules instead of $1.12 million. So there's a significant difference. And this would apply as well if you were selling the interest for cash or in a note. The IRS would deem that you would have to use the $4 million value in that sale under the new rules and pay gain and income tax on that rather than the $2.8 million. And so that could have been very significant, and it's quite fortunate that we are where we're at today, that hopefully that won't become an issue. And so we are going to jump through a lot of detail here in what's changing and how it would have worked and such. As Paul said, we're going to skip about 16 slides here. And we're going to get back down to the really the end of what's going on here. So I'll keep jumping forward here. So if you look at, what should you do now? Succession planning is always something that's important in a business. And if you're doing succession planning, I would suggest that's something you should continue on with. If you're not doing succession planning, regardless of whether there's an estate tax or these valuation discount rules, that's something you should be considering to move forward with some consideration or moving forward with your succession planning. Because you have to remember, valuation discounts are just one of the benefits of estate tax planning, but not the only benefit. And it's not the only tax benefit. So if you are thinking about succession planning, don't let this get in the way of continuing to move forward with that. So now we're going to kind of jump off the slides and move into the first other recent development, and that is the impacts of the election in November and President Trump being inaugurated last week as the new president. And along with that, there are potential for major tax reform. And we believe that the opportunity for major tax reform is the greatest that it's been in a long time. And it appears that we have the greatest possibility of significant reform and benefits since 1986. Actually, over the last 3 sessions of Congress, this process had already started. And over the last 3 years, there have been over 80 hearings evaluating different opportunities and options for tax reform. And so this is going to keep moving that process forward. Again, before the election in May, the House Republicans issued what they call their Way Forward plan. This plan has significant detail, not surprisingly, and it covers different areas of corporate and individual taxation. And so if we look at it from a corporate taxation and what the congressional Republicans have proposed, it would reduce the corporate tax rate, C corporations, from 35 to 20%. Their way of dealing with income and flow-through entities, partnerships, S-corps, LLCs, which the vast majority of dealerships are organized as, pass-through income under the House plan would be taxed at 20%, or 25% rather. In addition, the House plan, Republican plan, would repeal the corporate AMT. It would provide for the full expensing of tangible and intangible assets. So in the past, we've had something called bonus depreciation that allows, for example, a first-year write-off of 50% of new tangible property. This would be like supercharged bonus depreciation because you'd get to write off 100% of not only newly acquired, but if you acquired pre-owned assets, and it would also apply to intangible assets. So if you bought the assets of a dealership and that included blue sky or goodwill value, you'd also get a full first-year write-off of that instead of spreading it over 15 years. So that's a pretty meaningful part of the plan as well. There are some offsets. Their plan would provide for no deduction for net interest expense. So in a dealership, you'd have to look at your interest income, and then primarily your floor plan interest expense would be non-deductible when netted against that. The House Republican plan does retain LIFO. It does suggest eliminating some unspecified deductions and credits. Generally, what's been talked about are things that wouldn't typically impact a dealership, other than advertising is one of the things that would be a significant deduction to lose for tax purposes. The House Republican plan creates what's called a territorial tax system. And this is what's being referred to as border adjustment. And this is perhaps one of the most talked about pieces of the potential tax reform. And initially you might go, well, what's that mean, border adjustment? So if you think about a product that's manufactured in the US, and let's say you manufacture that product for $500 and you sell it for $900. If you manufacture and sell that product in the US, you'd sell it for $900 as your sales, you'd have $500 of cost of goods, you'd have a $400 profit on that transaction. Now let's say you still manufacture in the US, but you sell the product overseas. Under this proposal, your $900 of sales would not be reported for tax purposes. You'd still report your $500 of cost of goods sold, and you'd effectively have a $500 loss on the sale of that product. Now we flip this around. Let's say you manufacture it overseas, import it, and sell it in the US. Well, now you've got $900 of US sales, but you don't get to deduct the cost of goods sold. So now you have $900 of profit on that sale of that product. And so as you can see, that could be quite significant. If you look at it in the automotive industry segment, where the supply chain for automobiles is very global, this could have a significant impact. As a matter of fact, if you look on window stickers and such, where it does identify the domestic content of a vehicle, you're not going to see a number much higher than 70%. And so this would have a significant impact on the automotive industry if something like this is enacted. Other aspects of the Republican plan are the provisions for repatriation of overseas profits. And under the House plan, any cash profits brought back to the U.S. would be taxed at 8.75%, and any non-cash earnings brought back to the U.S. would be taxed at 3.5%. And that tax would be spread over 8 years. So those are the corporate provisions. From an individual standpoint, they would reduce from 7 to 3 income tax brackets, 12, 25, and 33%. Dropping the top rate from 39.6 to 33% would be a significant benefit. They would allow, instead of a capital gains 20% rate, you'd get a deduction for 50% of net capital gains, dividends, and interest. So those items would, at the individual level, effectively be taxed for a top rate earner at 16.5% versus today's 20 or 23.8% with the net investment income tax that dividends and domestic dividends and capital gains are taxed at. The House Republican plan would also repeal the individual AMT. So then if we flip and move forward to President Trump's proposals, and a lot of his proposals during the campaign process very much migrated toward the Republican proposals that came out in May. Needless to say, his proposals are far less limited in detail than the House plan is, and yet fairly similar. So from a corporate standpoint, you would have a reduction in the corporate tax rate from 35 to 15%, rather than the 20% that's suggested by the House plan, House GOP plan. And the way that Trump had proposed dealing with pass-through income is that you would be able to make an election to essentially have that pass-through income taxed similar to C-Corp income at 15%. However, it would then be subject to double taxation on distributions of that income, similar as the double tax on C-Corp dividends. From a corporate standpoint, there would again be a repeal of the corporate AMT. There would be a repatriation tax, but in this case, it would be simply a 10% tax on both cash and non-cash profits repatriated. And rather than the border adjustment, it would provide for tariffs on offshore products that are imported into the U.S. From an individual standpoint, you'd still have a reduction from 7 to 3 tax brackets, and those would still be at the 12, 25, and 33 rates. However, you'd have a retention of the current maximum capital gains rates at 20%. You would have a repeal of the AMT similar to the House GOP plan. Probably the biggest individual difference is that the Trump proposal would tax carried interest as ordinary income, which would be probably significant for certain earners, but probably not terribly significant for most dealers. Looking at some of the other things that are similar, both plans would repeal the state and gift tax. Repeal of the Obamacare would mean a repeal of the 3.8% net investment income tax. So those are the House GOP plan and the Trump plan, fairly similar. Now, in addition to that, Senator Orrin Hatch has indicated that he's soon going to be releasing what's being referred to as the Hatch Integration Plan. It's not yet released. We have very limited details, but one would expect that it will draw somewhat from the GOP plan and the Trump plan and probably mix in some new twists on top of that. So from there, if you look at the path forward on tax reform, this is still a very difficult process to get through. You have to first achieve some level of consensus on the substance of what will make up any tax reform, and that could include a significant amount of transitional rules from the old tax regime to whatever might be the new tax regime. Once you have that sort of consensus, then you have to navigate the political and legislative processes, which are, to say the least, very extensive. If you look at this and where we're at today, my opinion would be that if something can happen in the first 100 days, there's a pretty good chance that you're going to see income taxes go down for 2017 for the current year. If we get past that first 100 days of Trump's administration, and this hasn't occurred or hasn't made significant progress, then I'd expect that this is probably not going to get implemented for 2017, and it will take some time, and you would probably be looking at 2018, or depending on how obstructionist the Democrats might be, you might get out into maybe the third year of Trump's term after the midterm elections that something could happen. Overall, the potential benefits for dealers are very great by way of the reduced tax rates that would provide some permanent savings. The full expensing would be a timing benefit, but would provide some a deferral for many dealers of taxes. One thing about that, the idea of this 100% expensing has a lot of traction. It's something that there seems to be a lot of consensus on that point as something that would be good to include in any major tax reform. So much so that some people are suggesting that it should be extended out to inventories, which for dealers would be hugely significant to think about being able to write off 100% of your inventories. Not sure how that would get phased in and what those transition rules would be, but that would be very, very powerful for dealers. The state tax repeal would be very beneficial for dealers. The potential drawbacks are going to be no deduction for net interest expense and potentially limited deductions or no deductions for advertising expenses. Another thing that would come into play that most, at least flow-through dealers don't deal with as much anymore is reasonable compensation. That would become a bigger issue again as you look at how much is W-2 wages to the dealer taxed at 33% versus what might be flowing through to them at 15 or 25%. And with that, thank you, and I will hand it off to Buddy.
Thank you, Joe. I appreciate that. Nice to be with you guys this year, and I echo Joe. It's an honor to be here on the podium, and I'm going to start going over some recent developments that are current law. So everything I'm going to be talking about is the way that the tax law is today, and the way it will be for the foreseeable future, unless there is significant legislation. So recently, we've had some permanent extensions. So that means these changes are now permanent unless something were to happen in the future. So state and local sales tax deduction, if you live in a state that has a state income tax, that deduction is now permanent. It previously has been extended, but now that's been made permanent. $100,000 charitable distributions from IRAs and 401ks. So what this means is if you make a distribution from your IRA or a 401k directly to a charity, it has to go directly to the charity. Some people have asked whether it could go to like a community foundation or something like that, but it really needs to go directly to the charity. Then you don't pay any income tax on the $100,000, but you also don't get a charitable deduction. But under the current tax law, that usually works out to be a better answer. And it's really good for estate planning because IRAs and 401ks just get clobbered in estate tax, and when you pass those down to the next generation. The next several items I'm going to talk about are, like what Joe was talking about, the purchase of tangible property. So Section 179, which allows us to immediately write off the purchase of tangible property, has been increased to $500,000. And that phases out once you start getting over $2 million in property placed in service. So sometimes it impacts our dealers if we have large loaner fleets, where if they put a lot of loaners in place, maybe the Section 179 might not be available. 15-year straight line depreciation for qualified leasehold improvement property and qualified retail improvement property, so QLIP, QRIP. And now we've added a new category called qualified improvement property. And so these are all improvements, and as we know, dealers are under all kinds of image programs these days, and sometimes what you do is not necessarily enough money to do a cost-seg study, but these can be fairly powerful. So just real quickly, qualified leasehold improvement property is improvements made to property that is under a lease. It gets 15-year treatment. It is subject to bonus depreciation, so you do get some accelerated write-off. It is subject to Section 179, so you, again, could get some accelerated write-off. There are some limits there on the 179. The kicker with qualified leasehold improvement property is that it has to be leased from an unrelated party. And in many cases with our dealers, they own the property through a related real estate company. Now, qualified retail improvement property is improvement made to the retail area of a dealership. So this would be the places where the customers shop. It is 15-year property. You can take bonus depreciation on it. You can take Section 179, and you don't have that related party problem. So you can be renting from an unrelated. You can be renting from a related party. Excuse me, and still get the benefit of some accelerated depreciation. The last category, qualified improvement property, is any improvement made to the interior of the facility, so not just the retail area, but think the accounting office or the restrooms or the service drive or the parts department. It's 39 years, so not as advantageous as the first two categories, but it is subject to bonus depreciation. It is not subject to Section 179, and the lease can be with a related party. So just keep those in mind. These really do come into play when you do a $700,000 or $800,000 refresh in the showroom and things like that. This is where we typically see these. The de minimis expensing, so you can write off $2,500 per item per invoice. And so what that means is if you bought 100 computers and every one of them was $2,499, you could write off all of those computers and they wouldn't be subject to any of these other Section 179 or other bonus limits or anything like that. Now, the kicker is you need to do this for book purposes. So some of our dealers have said, it impacts my pay plans. I'm not sure I want to do that. But just know that it's out there. If your organization gets a certified audited financial statement, that limit has increased to $5,000. So you could buy 100 computers at $49.99, and you could write all of those off in the year of purchase. The last item on this page deals with a C corporation converting into an S corporation. We don't see that many C corporations anymore, but used to, we had to take a look at what was called the built-in gains tax, and that basically said the difference between the fair market value of your assets and their basis at the day you convert, that's called a built-in gain, and you've got to track that. If you dispose of any assets in a 10-year window, then you still have to pay C Corp tax, and you have the double taxation issue. That has been, permanently reduced to 5 years now. These are just some other extensions, so not permanent, but 5-year extensions. So bonus depreciation, again, for several years we've kind of been in limbo. We wouldn't know whether bonus depreciation was going to make it or not, and on December the 24th or 5th or 6th, we would get something that said bonus has been extended and it's retroactive to the beginning of the year. Well, now we have at least a plan, 50% bonus depreciation for 15, 16, and 17, and then it does phase down to 40% for 18, 30% for 19, then I believe it goes to 0, or it phases out, and we'll have to see what happens then. The work opportunity tax credit has been extended if you happen to be in an area where you're hiring qualifying individuals who would qualify for that. A couple of 2-year extensions. the alternate fuel vehicle refueling credit and the fuel cell vehicle credit. So charging stations, electric cars, those kinds of things. We do see this fairly frequently, and there are credits available. Those have been extended for 2 years. Section 179D, again, it's in either new construction or remodel. It allows a deduction up to $1.80 a square foot if you meet certain green criteria. This is a deduction, not a credit. And we don't really see this very often in our dealer group, but because the square footage is not large enough to make a huge difference, but it is out there and could be advantageous. Again, who knows what's going to happen to the Affordable Care Act, but one of the largest revenue raisers to pay for Obamacare was this thing called a Cadillac plan tax. Basically what it was is if you offered certain coverage that was deemed too rich by the tables that they put together, then the employer would be subject to or the plan would be subject to a Cadillac tax. The problem with it is that those limits are only indexed to the CPI, but as we all know, healthcare premiums, and so that say is 2.5%. Healthcare premiums are rising at 6 to 8 to 10% a year. So there's going to be a point there where the intersection subjects a lot more plans to the tax, and that's when the revenue part was supposed to really kick in. So who knows whether that'll happen or not. Large employer and all the reporting and whatever connected to that has decreased from greater than 100 to greater than 50. So just be aware of that. Partnership audit rules. This is new for 2017. So think of an LLC taxed as a partnership, a general partnership, a limited partnership. The audit, used to what happens is the entity gets audited, and then all of the all the partners have to amend their tax returns to reflect any of the audit adjustments. And the IRS figures that they really have a lot of slippage there because many people may not amend their returns, and it's hard to chase everybody down. So beginning in 2017, the adjustment is going to be made at the partnership level. Now, just this week or a week ago, there were 280 pages of proposed regulations dealing with the mechanics of how this would work. There are some opt-out provisions if certain criteria is met. You have to have less than 100 partners, and the only partners that you can have in order to opt out are individuals, C corporations, S corporations, and the estate of a deceased partner. So if you have trusts, for instance, as a partner or a foreign entity or whatever, then you would not be able to opt out. But the new regs do have what they call these push-out regulations. So in other words, you could take the adjustment and push the effects out to your partners as far as having them pay. But there again, it's very hot or fresh off the presses, and I'm not sure. It's fairly complex how you would do those adjustments. We do have new tax return due dates. So C corporations are moving from being due the 15th day of the third month to the 15th day of the fourth month. Partnerships are moving from the 15th day of the fourth month to the 15th day of the third month. S corps, there is no change. I think the real reason here is that what they would like to do, the goal is on flow-through entities, they would like for the owners to be able to get their K-1s a month ahead of when the individual tax returns are due. They feel like that also there's slippage there, and that this gives the IRS a better opportunity to get the right number on the individual returns. Trusts are going to have a 5.5 month extension, which makes them due, a calendar year trust would be due September 30. W-2s and 1099s are due to the IRS by January 31st. That's next week. Used to that we had till the end of February. I'm sure you all know about that, but I just thought I would mention it in case that you didn't. We don't see the last item very often, but the what's called the F-bar, that basically is if you have signature authority over a foreign bank account. There's disclosure that has to be made. Used to be this was due on June 1, which was a really odd date, and sometimes that could slip through the calendar. Now they're due on April 15th, and it's due with the return, and that makes a lot more sense. And they're even going to allow extensions until October 15th, just like your tax return. A couple of other miscellaneous provisions. Again, an area where the IRS feels like there's slippage in revenue reporting, and this is in the area of basis. So if you overstate basis on like a capital transaction, if you're selling stock or other assets, then if the IRS has determined that you've overstated your basis, therefore understated your gain, the statute of limitations can be extended from 3 years to 6 years. And then in the case of estates, used to estates didn't have to report what the basis was to the heirs that were inheriting the assets. Well, now there is a requirement to do that. Form 8971, it's due 30 days after the earlier of the due date of the return or the date the return is filed. So the goal there is that the IRS now has the same information, and if you're going to dispose of an inherited asset and the basis doesn't match up, they've got a lot better chance of catching that. A couple other items here. Recently, I guess for those of you who are Volkswagen dealers, the judge signed off on the fairness. The fairness hearing was this week or last week, and the judge signed off that the settlement was fair. And so many dealers are going to be getting this settlement dollars, and so there's been a lot written and said about what is it. I think generally most of the firms that we know that deal with this area feel like that what we're probably talking about is some kind of basis reduction if you have a basis in goodwill or intangible. Then capital gain after that, potentially some ordinary income there if you have taken amortization deductions on the intangible. And since this is being paid over, in some cases, 3 tax years, so some dealers got money in 16, they're going to get 12 payments in 17, 6 payments in 18. Installment, almost like installment sale reporting, appears to be available for that as well. So there are a lot of things that there are a lot of different facts and circumstances that are very dealer specific or very dealership specific, depending upon how your goodwill was acquired, whether you have an open point, all kinds of different things. So you just consult with your tax advisor on that as to how you're going to account for those items. And the last thing I'll talk about are these Section 385 regulations. Basically, these are incredibly complex, and they deal with debt, whether certain kinds of debt really is more like equity. If it has characteristics and features in there that make it look more like equity than debt. And there are special rules about that. What for us and for our dealers, we were very pleased to see that S corporations are specifically excluded. The concern there was if there were certain debt instruments that the IRS was going to recharacterize to equity, then we might find ourselves with a second class of stock, and an S corporation can't have a second class of stock, so then our S corporations would be turned into C corporations. But under these final regulations, S corps were specifically excluded. Oh, I do have some brackets there. I'm not going to spend time. They're in your materials and in the handouts or the. I will point to the last 2 items on this slide, which are the gift tax exclusions. For 2017, they remain. The annual exclusion remains at $14,000 for an individual, $28,000 for a couple that elects to split gifts, and then the estate tax exemption has risen to almost $5.5 million per person. So, again, those are there for your reading pleasure after you get in from Bourbon Street tonight. But with that, I'll pass it over to Jay.
Thank you, buddy. I'm going to continue with the theme of recent developments and specifically focus on a couple of recent developments in the area of reinsurance. First with F&I companies, and then a little bit with maybe some enterprise risk companies. The most common structure that we see for these reinsurance companies, for dealerships, for F&I, is to form a corporation offshore. And while a lot of people's initial thought is that the offshore thing has something to do with taxes, it really doesn't. It typically is done for regulatory flexibility and for capital structure requirements. But it's not really a tax thing, because in most cases, the money never leaves the United States, and the first thing that's taken after the company is formed, the first election that's made, is what's called a 953D election, which means you're going to be treated as a U.S. taxpayer anyway. The second election that these entities typically make is a 831B election if they qualify, and that's an election for a small insurance company to elect to be taxed on their investment income only and not on their underwriting income. So the recent development has to do with what makes somebody eligible to make this 831B election. Prior to the PATH Act of 2015, for tax years 2016 and prior, the premium limit was net written premiums of $1.2 million or less. And that's been that number for a long time. It hasn't changed. It hasn't been inflation adjusted, and it's been harder and harder for dealerships to continue to stay underneath that level. So the PATH Act, effective 1/1, increased that limit. First, it increased it to $2.2 million in net written premiums adjusted for inflation. There was actually an inflation adjustment even before it went into effect, so now it's $2.25 million for 2017. This thing keeps falling. And expected to go up annually. They did also add diversification tests that you need to pass in order to be eligible. There's 2 tests. If you pass the first one, you don't need to be concerned about the second one. The first one is that no more than 20% of your net written premium can come from any one customer. And the second test has to do with ownership and would effectively require the insurance company and the dealership to have the same ownership. So a common question that's come up on the first test with the customers is the customer the dealership that cedes the money to the insurance company, in which case almost all dealerships would fail this 20% test, or is it the customer who bought the car, who bought the service contract or other policy that ultimately ceded through? And the answer is it's the customer. So because it's the dealership's customer, not the dealership itself, it's very, very likely, at least in the F&I captive reinsurance world, that you'll pass test 1 and not need to be concerned about test 2. If you're doing any of these enterprise risk captives, and we'll talk a little bit about more them in a second, you will fail test 1, and then you'd have to be concerned about test 2, and we'll come back to that in a second. There's a lot of benefits to these reinsurance companies, to these captives, which is why they're so popular, but one reason you might not have done them in the past is because the $1.2 million limit was too restrictive, and maybe now you would reconsider it with the $2.25 million limit. So some of the benefits, just as a refresher, if you're considering it, you would get to participate both in the underwriting profits as well as the investment income, but you'd only be taxed on the investment income. You have a lot more discretion in terms of approving claims, since it's basically your money, and if you want to stretch the rules a little bit, you can. It's portable as things change with your... Oh, thank you. It's portable as you might have changes in the number of dealerships you own or the franchises you represent or who you do business with. And you also have input into investment decisions, not necessarily on there's money that's statutorily controlled, but to the extent that you have excess money in there, you would be able to have some input into the investment decisions. Additionally, you can borrow against those excess funds. You might be able to use that to help fund growth or provide working capital for a dealership. There's estate planning and employee retention opportunities. You could make your kids or your grandkids owners in these things. You could make key employees owners in these things that you want to retain. It's a great retention tool while you want to retain that employee. Sometimes things change and you no longer want to retain that employee, and it's not such a great tool at that point in time because it can be hard to get them out. So keep that in mind. It provides for tax deferrals until you bring the money back in, and when you do bring the money back in, it's very likely to be taxed at either capital gain or qualified dividend at lower rates. So there's lots of benefits. This F&I captive structure works really well for this. Whenever there's something with lots of benefits, people find additional ways to apply it and additional opportunities, and that's where these enterprise risk captives have come from. Those are captives that are formed to insure other types of things for the dealership. Sometimes it's used to insure the deductibles on your traditional policies, to protect against lost franchises, to protect against loss of key employees, and different things like that. And they work, they're fine. You have to, if you properly go through underwriting, if you properly go through actuarial adjustments and actuaries, and if you actually have claims, there's no reason these things can't work. So it's a nice extension of this. The other thing that happens when something is good and has tax benefits is people, then go another step and they get to the point of being a little bit greedy, going a little bit too far, and maybe potentially taking advantage of it. So the example, I guess, would be if you're in Florida, hurricane insurance might make sense and you might want to insure yourself against that. If you're in Oklahoma, it might be a little bit harder to justify that. And unfortunately, there's people that have done things like that. That's caught the IRS's attention, and that brings about the second recent development, which is so recent, in fact, that we don't have slides for it because it came out in November, and as Paul mentioned, we turned our slides in October. But the IRS issued Notice 2016-66 on November the 1st, and that identified certain captive insurance companies as what they call a transaction of interest. They put them on their dirty dozen list, which are the things that they think are most susceptible to abuse, and transactions of interest have additional reporting requirements. I don't think any of us believe that the intent was these traditional F&I type reinsurance companies. We think it's more these enterprise risk companies that are being a little bit extreme. But as the definitions stand currently, you really need to read it. You need to study any reinsurance companies you have because it very well may be captured in this notice, and it might have additional reporting requirements. If the current thinking is that if all of the products that seed into your reinsurance company are admin or insurer obligor, you're probably outside the reporting requirements. But if anything, service contracts, gap, limited warranties, if anything you do is dealer obligor, you probably do have additional reporting requirements. And there's reporting at the reinsurance company level, at the dealership level, and at the shareholder of the dealership level that participate in these. Originally, the November 1st notice had a compliance deadline of January 30th, which is just a couple days from now. There was some pushback from the industry that more time and more information was needed, so a notice came out, 2017-08, that extended that deadline until May the 1st, so there was a little bit more time for prior year information and for prior year returns. But if you're filing returns now, if you're ready to file an S Corp or C Corp return, March 15th or April 15th, that's prior to that May 1st date, and you are subject to the additional disclosures, those disclosures should be with that return. So if you don't have all the information, you might have to extend just for that. There are still industry insiders working on this, hoping to get more clarification, hoping to maybe get us a new definition that excludes us from these. And also there's hope that with the new administration and some of their pledges on less regulations and being more pro-business, that maybe this whole thing will go away. So stay tuned. There's a lot that's going to probably happen between now and May, but keep your eyes on that. The other topic I'm going to cover is what we're calling important reminders. If anybody's come to this session, year in and year out, thank you for that. But if anyone's come to the session year in and year out, you've probably heard most of these things before. These aren't necessarily new, but as we work with new clients or prospects, and I'm sure Buddy and Joe would agree with me, there's still a lot of things we see out there that we think people could or should be taking advantage of that for one reason or another they're not. And these are just things that we want to remind everybody of in case you're not taking advantage of them. A lot of them are in the area of inventory, as you might imagine, because of the dollars that are involved and because some of the tax opportunities that exist. So I'm just going to talk about a couple of these. Trade discounts, any money that you get from the manufacturer solely because you bought the car from them. So floor plan interest credits is an example. In some manufacturers, the advertising money is an example, and in some cases it's not, because if it's a co-op and if you have to run a certain ad and submit a certain ad, then there's strings attached. This only works if there's no strings attached. And then other manufacturers have other programs with different names. But if you follow the manufacturer accounting manuals, in a lot of cases you're taking this into income as you buy the cars. And the IRS allows you to treat it as a trade discount. In fact, says it is a trade discount, and trade discounts should be part of the cost of the car, should ultimately run through cost of sales, and therefore should be deferred. The recognition should be deferred until you sell the car. Most of these things that I'm going to talk about, you could do differently for tax than you do for books. So we could do this in such a way, if we work with your controllers or your CPA works with your controllers, to not necessarily change your dealer statement, not necessarily mess with people's pay plans. There's journal entries and bookkeeping ways to do this. But this is one that's interesting, because if you think about it, currently your most profitable months are probably the months when you buy a lot of cars, regardless of what you sell. And maybe there's some reasons to think about doing the same on the books, because your most profitable months should be when you sell a lot of cars. Going the opposite direction, there sometimes is an advertising charge on the invoice when the manufacturer's passing along an advertising expense to you. If you just book the invoice, a lot of places are putting that into the inventory, not taking the deduction until they sell the car. This kind of goes the opposite. There's the opportunity to accelerate that deduction and take the deduction even before the car's sold. Unicap is another one. A few years ago, this became potentially a very big issue up with some IRS agents in the Northeast. They were going kind of half-cocked and proposing some huge adjustments to dealerships that would increase the inventory and defer deductions. Fortunately, Paul was talking about advocacy earlier. NADA and Paul got involved. Got a meeting with the IRS where some industry folks were able to explain to the IRS kind of how our industry works, why the things that they were saying were wrong. They ultimately agreed with us that their folks were wrong and generated a new safe harbor that exists. So unless you have off-site storage, in almost every case, this Unicap adjustment, these operating expenses that would need to be capitalized into inventory until you sell the cars, is going to be a very, very small number, and in many cases it's going to be zero, provided you make this election. And we still pick up clients or look at tax returns for other dealerships that still have large adjustments in this area. Internals, this concept came out of that same meeting with the IRS. The concept here is you can't make a profit selling something to yourself, and you don't need to capitalize the salary costs of your own people. So the typical approach in a dealership, you run a car through the shop, either new or used, you take the RO, you put the entire value of the RO into inventory. Again, makes sense from a business perspective, but from a tax perspective, the labor portion of that can entirely be deducted at the time, and the gross profit on the parts can be deducted at the time. You don't need to wait until you sell the car. The only thing that the IRS thinks that needs to be added to the cost of the car is the hard cost that you paid to a third party for the part itself. And again, there's ways we can shortcut some of these calculations and get to these answers without a ton of labor and without changing your internal process. A couple reminders on LIFO. If you want to use LIFO for your tax return, you have to use LIFO for all financial statements that you produce, anything that's given to the manufacturer or to the bank, and this is typically done through booking an estimate on the 12th month. I think everybody knows that one. Don't see that one missed very often, but it can be somewhat catastrophic if you miss it because it could result in you being removed from the LIFO method. LIFO pooling, when most dealers elected LIFO, you had to keep your cars and light-duty trucks in two separate pools, two separate LIFO calculations. That is no longer the case. You can now combine them into one. With SUVs and CUVs, and with it getting harder and harder to determine what was a car and what was a truck, I think they finally just gave up on that. The reason you would want to do that is it takes some of the volatility out. As gas prices change and as consumer demand changes, or as different manufacturers, produce or don't produce cars, and you had big swings in your cars relative to trucks in your inventory, you could get some weird LIFO answers, and this helps take some of the volatility out of that. The final concept I want to mention on inventory is used car write-downs. You can write down your used cars at the end of the year to fair market value, provided you're using some third-party valuation like the NADA guide or auction data. You have to be consistent in the way you do it from one year to the next. And it's a car-by-car thing. It's fair market value, lower of cost or market on a car-by-car basis. So if one particular car is overstated by 500 above market and another one's below market by 500, you don't net them to zero. You get the benefit of the $500 deduction. Some other opportunities exist in prepaid expenses on your balance sheet. Provided you've paid the expense, provided you've made the payment, and provided the term is 12 months or less, you can take the deduction in the year that you make the payment. So the easiest example to think of this is real estate taxes. Where I live in Maryland, the real estate tax year for the government runs from July 1 through June 30. So on your balance sheet, you're likely to have 6 months of that sitting in prepaids at the end of the year, but because you made the payment and because it's 12 months or less, you could accelerate the tax deduction into the year that you paid it. So for example, if you're a December year end and you have a maintenance agreement on your copiers or your HVAC and it runs from December 1st through November 30th, you make the payment in December, you've got 11 months sitting in your prepaids, you could write that off for taxes. If it runs from January 1st through December 31st, even if you pay it in December, doesn't qualify because no portion of that relates to this year. So things like January's rent and January's health insurance premiums that we sometimes see in prepaids don't qualify. Also, a lot of opportunities in fixed assets, again, because of the dollar amount at stake and all the different rules. Cost segregations, Buddy touched on that just a little bit earlier, but anytime you do new construction, a major renovation, or buy a building from somebody else, our rule of thumb's typically been $1 million or more. The cost benefit is probably going to be there to do a cost segregation, get the accountant and the engineer together, try to get things out of that 39-year life and try to get better answers, better depreciation answers. If you've done a renovation in particular, you should consider a partial asset disposition. This involves looking at what portion of the building that used to be there and it was still being depreciated isn't there anymore. It gives you the opportunity to write that off all at once. It can be a pretty significant number. You might want to do planning ahead of time because you might want to make some decisions about whether the entity that owns the building or owns what's currently there and what's being disposed of should pay for the renovations so that all the money's in the same set of books. De minimis safe harbor, Buddy touched on, so I'm not going to repeat that. Qualified improvement property, Buddy touched on as well. But again, the idea there is by default, buildings and leaseholds get 39 years, don't get bonus, don't get Section 179 unless you find one of these exceptions. And if you find the exceptions and you can use 15 years or bonus or 179, you get a better answer. General asset accounting is an election you can make. If you buy a series of assets, I think, let's say you bought everyone in the organization an iPad, 500 iPads, and it's not worth the effort just to keep track of who broke theirs and who lost theirs in the next 5 years. You just want to depreciate all 500 for the next 5 years. Even if you don't have all 500 of them at the end, you can make this election. There are some potential cons as well as the pros. So a pro might be if you buy a building and you intend to use it and you make the selection and 15 years from now, out of the 39-year depreciation, you tear it down. If you hadn't made the election, the remaining basis in the building becomes land, and land is non-depreciable. If you had made the election, you would continue to depreciate this for the rest of the 39 years and keep your land basis lower. The downside would be if you make this election and then for whatever reason you sell the building or subdivide the property and sell some of the property or whatever, your entire cash proceeds is gain because you have no basis with which to offset it and reduce the profit. Self-rental, to the extent that you rent properties to yourself, to the extent that you're the tenant and the landlord, the IRS is going to give you the worst possible answer in terms of active versus passive treatment. If you have profit, it's active, and if you have passive, it's loss. In most cases, you want to avoid passive losses, and sometimes it's just as easy as changing the rent a little bit to make sure that the real estate entity has gains, and that you will, in essence, get the deductions by making them active at the dealership level. There was a grouping election that could be made last year. Again, in order to make the dealership activities active and not passive, and in a trader business, you have to spend at least 500 hours per year working in a trader business. For some of the bigger groups where a dealer might be involved in 5, 10, 20 different dealerships, it would be hard to produce timesheets or whatever that show you spent 500 hours at each of them. So you could make an election, group them all together, treat it as one activity, and then as long as they work 500 hours across the entire platform, you would get active treatment for that. Just a couple other reminders of some things we've seen in audits over the last couple of years, or some kind of low-hanging fruit stuff that people still get wrong sometimes. If someone's driving your car, if someone has a demo, they have imputed income. Whether it's $3 a day or more, you have to go through the different rules, but the answer is not zero. And the IRS knows this, and the IRS asks about it, and it's the low-hanging fruit, so to speak. DX drivers in most cases should be on W-2s. We still see people trying to give them 1099s. Very rarely is that the right answer. There's overtime issues, workers' comp issues, payroll tax issues there. Cafeteria plans, greater than 2% shareholders can't participate in a cafeteria plan. See that mistake made frequently. S-Corp distributions, owners have to take their distributions pro rata to their ownership percentage. If one person owns 80% and takes $80, the 20% owner needs to take $20 as well. And reasonable compensation, not a big issue very often, but in a C-Corp, sometimes you try to take too much and it looks like you're trying to avoid dividends. And in an S-Corporation, sometimes it looks like you take too little and you're trying to avoid payroll taxes.